Morning, everyone. Thanks again for coming today. So what we're going to talk about here for my session, we're not going to hit in depth every GASB that's on the horizon right now. We're going to spend a lot of time on leases, and then Teena Curnow is going to come up and go through sort of a quick summary of some other standards. So before we dig into this, I did want to articulate that GASB, of course, is the Governmental Accounting Standards Board. That is the national board that sets standards for governmental entities for state and local governments. Not every government in Pennsylvania applies those standards. Some of you that are in here in this room today, you don't apply those standards. You're maybe just cash basis. Kevin mentioned DCD only reports, townships and boroughs. A lot of you are just cash basis. In that circumstance, these standards that we're going to talk about likely don't apply to your situation. So just to kind of frame where you may be here this morning. So digging into leases, and we're going to talk about, this is GASB 87, and then kind of I'll say a mirror standard, GASB 96, for what's called subscription-based information technology arrangements, or SBITA for short. So for those of you who have implement GASB standards, who have those types of financial statements, what you're used to seeing with leases is capital leases and operating leases, if you're familiar with that. And that is what is going to be significantly changing. So what are we going to cover today in my part of the session here on leases? We're going to talk about the effective date, some transition considerations with the standard. We're going to talk about the scope, a little bit about the SBITA, as I mentioned, and then what I'll call is some of the maybe call pain points or maybe some difficult points that we'll work through with our entities as we implement this standard. But separating components and allocating contract costs, selection and discount rates, which is very important. Then we're going to run through a sample transaction and talk a little bit about disclosures here with the leases. So the reason that we're going to spend a significant amount of time on this standard this morning is because it is very, very important, and it is a significant change. For those of you who are going to implement this standard, who have leases, it is going to be a significant amount of work for you internally and working with your auditors who are likely assisting you in preparing your financial statements to implement the standard. So I want to emphasize that up front. So what is the reason for this standard? Well, essentially it's to create a single reporting model for leases. And what we're used to today with operating leases, most of those are going to go away under this standard, and things are going to be treated somewhat similar to a capital lease, although the accounting is going to be very different. So what's the timing of the implementation of the standard? Essentially, it's now. This was effective or is effective for periods beginning after June 15, 2021. So those June 30, 2022 audits that we're working on right now and financial statement preparations, this is applicable for December 31st, 2022 for your year-end implementations. This was delayed 1 year. I'll mention that as a result of a standard. Really, that came out because of COVID. So we did have a little bit of extra time to implement the standard. So what is the scope of this? And what is the definition of a lease under this standard? So what I wanted to mention here that I think is an important concept to remember as we work through the implementation of this is that the contract doesn't have to be called a lease for this to apply. As you work through this, as you look at your own organization and you look at your various contracts, please keep that in mind. It may be called a lease, but it doesn't have to have that terminology for this accounting to actually apply. So I did want to read the definition and just go give you that word for it. A lease is a contract that conveys the control of the right to use another entity's non-financial asset or an underlying asset for a period of time in an exchange or exchange-like transaction. So essentially, you have a contract to use someone else's asset. The right to use of that asset, the asset has to be specified in the contract. And then you have to have this element of control. The element of control, you have that in two different ways. You have the right to obtain the present service capacity of the asset. So you're getting the use of the asset. And you have the right to determine the nature and manner of use of the underlying asset. That is an important piece because you have to have the control. You have to determine how that asset is being used. And an exchange-like transaction is applicable here. You may have what I'll call $1 leases. A lot of times that's with related entities. this accounting is not going to apply in that situation. There are some exclusions. For time's sake, I'm not going to run down through this entire slide, but there are certain items, certain accounting items that you're not going to apply this lease accounting. I'm not going to talk a lot separately today about the SBITAs, but what I'll mention is that this is going to be effective 1 year later. So this is going to be for June 30th, 2023 or December 31st, 2023 year ends. As we are starting to work through this with our clients, what we're really finding is that we feel this could have more of an impact than the leases that we're going to see this summer and this year end that are more the traditional leases that you're used to with equipment and maybe buildings, that sort of thing. With these subscription-based information technology arrangements, it's a concept that we really haven't even considered in the past. So I think, and I think a lot of entities are going to have a lot of these types of contracts. So what exactly is that? Just to mention that, well, essentially it's a right to use someone else's IT assets on a subscription basis for a limited period of time. So, and I'll give the example. I was mentioning to someone yesterday, I use Quicken. If anyone knows what Quicken is, it's sort of the personal version of QuickBooks. I'm still on the 2005 version of Quicken because I bought the CD 17 years ago and I never upgraded. So I own that software. That's my software. I bought the license to that. Well, that's not how they handle it today. If you go out to buy Quicken today, you buy a subscription, you have it for a few years, and then you don't have the right to use it anymore. So when you think about your software, think of it in those terms. You may have software, you may have it housed on your computer system, but if it's really on a subscription basis for a limited period of time, then this standard is likely going to apply. And on top of that, it's not just software. It could be any kind of IT related assets. Of course, the buzzword over the last number of years is cloud, and everything's in the cloud and cloud storage and data storage. You may have some type of arrangement along those lines where this standard is going to apply. A lot of the accounting and a lot of the rest of the presentation kind of mirrors between the leases and the SBITA. So I'm not going to draw out a lot of differences between the two from here on out, but I did want to work through that definition. So we're going to talk about kind of the steps that you need to take and some of the data that you need to gather for each of your leases to help it implement the standard. Then we're going to walk through some of the accounting and some of the transactions. So the first item right off the bat, when you have a contract that you're looking at, you've determined that this does meet the definition of a lease, is you need to determine the lease term. And that may seem fairly simple, but it can be complex if there are possible extension periods in a lease. Now, if you have, I'll say kind of a small lease, a copier lease that's 5 years, you're not going to have extension periods there. That's going to be pretty simple. Let's say you have a building lease and it might have five-year extensions as possibilities. That's where you're going to get into some complexity in determining the lease term. So the lease term, you start out with the non-cancelable lease period. That is always going to be included in the lease term. Then you look at these options. And the options either have to be on the lessee side or the lessor side. So if you have an option for the lessee to exercise a renewal period and they're likely going to exercise that, you're going to include that time period. Or an option to terminate and they're likely not going to terminate. On the flip side, if the lessor has those options to essentially force an extension or can force a termination is not going to do it, you're going to include those periods as well. If both the lessee and the lessor have those options together and either one can take those and exercise those options, you don't consider those periods. So I know it's a little wordy, but the main thing to take away here is that if you have, not the plain vanilla lease and you have something that has some potential extension periods, is that you're going to have to make a judgment call and determine how many of those extension periods you expect to be exercised. And that is not something that your auditors are going to be able to make that decision for you. That's really an internal management decision that will need to be made to make a judgment call on how many of those periods are going to be taken. And that's very important because that's going to drive the calculations significantly as we work through the rest of this. So there are different types of leases that you want to take into consideration. There is a concept of a short-term lease. The advantage of that short-term lease is if it is truly a short-term lease, then you're really going to treat it like we used to for an operating lease, where you're just expensing payments as you go. and all the complexity of this accounting doesn't apply. So what that short-term lease is if the maximum possible terms at the commencement of the lease are 12 months or less, then it's a short-term lease. Now, you may think, well, we have a month-to-month lease, but if you have possible renewal periods that drive that out past 12 months, it's not going to fit into that category. But that's something that you certainly want to take into consideration as you review the leases. The second one there is leases that actually transfer the ownership of the asset at the end of the contract. I'm not talking about a bargain purchase option, but it's actually built into the initial contract where it's going to transfer the ownership. If that is the case, then you're not going to apply this lease accounting. You're still going to have activity on the balance sheet. You're going to have an asset. You're going to have a note payable, but you won't apply the actual lease account. If it doesn't fit into either of those two buckets, then it's going to be in all the leases, and you're going to apply the accounting for lease liability and lease assets. So I mentioned this earlier, identifying and separating components is another one of those kind of challenge points that you want to consider with your leases. And the first step is to identify what the separate components are. Now, you may not have any in your leases, but I'll use the example of a copier. So let's take a copier lease, and you have one payment that you're making for that copier lease. But in that contract, of course, you have the right to use the asset, but there's also a maintenance component and a component where you're receiving supplies, maybe paper and tin. So in that circumstance, those non-lease components, which would be the maintenance and the supplies, they don't get incorporated into the accounting. So you have to separate out that transaction. Those payments for those non-lease components, they get expensed as you pay them. And then the remaining payment, that's what rolls up into this accounting for the lease accounting. And that may take some work as well to allocate that contract price, because the breakout of that price may not be included and likely isn't included in your lease contract. May take some communication with the vendor, may take some looking at fair market values of the items that you're receiving in order to allocate that contract price. The other item that I wanted to talk about a little bit here as far as a challenge point is the discount rate. So for those of you who have leases and you're thinking about your contracts, it's very likely that the lease does not explicitly say what the discount rate or the interest rate is on the lease. Now, it might be in there, and if it is, that certainly gives you a head start. But it's very likely that that's not included in there. Well, the discount rate or the interest rate that's included as part of the lease is a critical part of these calculations and is going to drive the recording of the lease liability and the lease asset. So this is an area where it's probably going to take some effort to determine what those discount rates are. So what do you do if the rate is not in the contract? Well, the thing that we're communicating to our clients is, talk to the vendor. If you're on the lessee side, talk to the vendor and see if they can provide that information. Think about that as you're going forward with your lease contracts. That's a piece of data that you want to obtain up front, the best that you can as you're entering into new leases. If the vendor can't get it to you, or you just can't get it from them, ultimately your fallback point is you're using your own incremental borrowing rate. And we'll talk about that a little bit more in just a second. But essentially, it's the cost of what it would cost you to go out and borrow money for a similar transaction. On the flip side, you may be the lessor, and we'll talk about some of the accounting for the lessor. So in that circumstance, it's also very likely that the contract doesn't include a discount rate. Maybe you're renting out some space in a building, and when you determine what the rent was going to be, you weren't necessarily thinking in terms of principal and interest. You were just thinking of fair market value for what the rent should be. So in that circumstance, again, it's going to be difficult to have some challenges in calculating that discount rate. Ultimately, you may need to fall back again on your incremental borrowing rate from the lessor side of things. How do you determine the incremental borrowing rate, your own incremental borrowing rate, if that's the direction that you need to go? Well, you need to take a look at your credit quality rating. That could impact what the cost of your borrowing would be. And ultimately, you need to take a look at your own debt if you have debt, and see if you have a recent debt issuance that's close to the timing of the lease transaction, and similar to the same period as the lease transaction. If you have that in place, then you can have a pretty good idea of obviously what your own incremental borrowing rate is. But if you don't have any debt, or you don't have a debt issuance of yourself that lines up closely to that particular lease, then you're going to have to dig a little bit harder to determine what that is. You can go out and look at market data, where you can see other governmental entities that are issuing debt, that are, again, similar types of transactions, similar credit quality ratings to what your own debt transaction would be, correspond to the lease. You can look at market indices. And if you have bond counsel involved, I certainly encourage you to talk to them as well, and lay out the scenario that you have for that particular lease transaction, and work with them. And they may be able to assist you in determining the incremental borrowing rate. One thing to point out is it's definitely not one size fits all. Even within your own leases, we would expect to be differences from entity to entity in terms of what their incremental borrowing rate would be. And also different lease transactions cover different periods of time and different dollar amounts. May have slightly different incremental borrowing rates in those circumstances as well. So we'll get into the accounting here, and we're going to start with the lease liability. And again, I'll just highlight, we're not going to talk separately about the SBITAs, because this part of it, the accounting is essentially exactly the same between the two standards. So you start with the lease liability, and we're really looking at this from the lessee side in these slides. And the first thing that you need to determine is what payment streams are you going to consider that are happening over the future to determine to roll up into the lease liability. Well, obviously, you're going to look at fixed payments. Likely your contract is going to include that. If you do have variable payments that are based on a particular index, you take a look at the index that's measured at the time of the initial transaction. Maybe you have some variable payments that are really fixed in substance. If there's items that you expect to occur at the end of the lease, maybe there's a residual value guarantee payment, or there's a purchase option that you expect to exercise, termination penalties, those types of things, the payments that you expect to happen throughout the lease. You're really looking at that as you roll up the future payment schedule for the lease liability. Then the lease asset is really an offset of that lease liability, except on top of the lease liability, you do add, if there's any payments at or before the commencement of the lease term, maybe you make an upfront payment, that actually gets added to the lease liability. Or if there's any initial direct cost, ancillary type costs to get the asset in service, those are added to that lease liability as well. The lease liability is amortized over the shorter of the term of the useful life of the asset, or the lease term itself, whichever is shorter in that circumstance. We're not going to get into the accounting of it today, but there are circumstances where you may need to remeasure your lease liabilities in the future. And one example of that would be, say that you made that judgment call up front on what the lease term was going to be. You expected a certain number of periods to be exercised in terms of those options. And that may change over time. That may change in the future. Circumstances change, maybe a building sold, et cetera, et cetera. And at that point in time, you would need to remeasure the transaction. You need to remeasure that lease. That remeasurement is handled through between the lease liability and the lease asset. Essentially, they're going to offset each other. So before I jump to the next slide, I wanted to say, ultimately, once you determine these payment flows, you have the term, you have the discount rate, then it's a matter of creating amortization schedules. I'm sure you're all used to seeing an amortization schedule for a debt where you have principal and interest payments in the future. Essentially, it's the same thing for the lease liability. You're also going to have an amortization schedule for the asset piece, and that's going to be very similar to a capital asset, likely straight line as well. So if you think about that in those terms, for every lease that you have that meets this accounting, you're going to have two amortization schedules, one for the liability, one for the asset. They're not going to be the exact same. They're likely going to be a little bit different numbers. So if you have one lease, maybe not too much effort there. If you have 50 leases, that's 100 amortization schedules. So, just keep that in mind as you think about the work that's involved with implementing the standard and doing these calculations. So these couple slides here, we walk a little bit through some of the transactions. In the initial reporting for the lessee, you're going to record that intangible lease asset. And I want to stop there and pause there for a second and emphasize the asset that you're booking is not the actual physical underlying asset. You are booking an intangible asset as the lessee, a right to use the asset. So it's a little bit different, but it's just a concept to keep in mind what that asset really represents. So you're booking that intangible lease asset. We talked about the accounting for that before. And then that's offset by the present value of the future payments of the lease liability. So again, you're creating that amortization schedule for that lease liability to determine the amount of liability that you're going to record. If you are on the lessor side of things, you're going to record a lease receivable. Essentially, it's the same calculation as the liability on the lessee side. You're going to continue to report that leased asset. So you're the lessor. That's an example of a building. You still have the building on your capital asset listing. You're still depreciating that just like you were before. Then the lease receivable, that is offset by deferred inflow. Kevin talked about that a little bit in the previous presentation. That's going to be offset by a deferred inflow. So the subsequent reporting is from the lessee side as you make payments. Well, as you make a payment, very similar to making a payment on a debt or a note payable. You're going to reduce the lease liability by a principal portion, and you're going to have interest expense. Then that lease asset, that right to use intangible asset, that's going to be amortized into the income statement, very similar to a capital asset and depreciation. On the lessor side, again, you're going to continue to depreciate that leased asset. As the lessor receives payments, they're going to reduce the lease payments receivable. You're going to have some interest income side of things running through as revenue. And then that deferred inflow, you're going to recognize that as revenue as well over time. So we're going to walk through a sample transaction here, pretty basic, but just to give you a flavor of how some of these numbers come together. So in this example with the lease, we have a lease that when the inception date of the lease was the actual implementation of the standard, July 1st, 2021. You had some initial ancillary costs of $10,000. That lease term that you determined was 3 years and requires annual payments of $100,000. And you determine that the interest rate or the discount rate is 5%. So the schedule on the right-hand side just shows you that flow of payments, that initial $10,000 upfront payment, $100,000 payments each year at the end of the year. So the first step is you're going to create your first amortization schedule for the lease liability. And again, same thing as doing this for a note payable. There's no difference here. You're using what we have here on the slide as an Excel formula that you can use to do that calculation. But you're discounting that back using the term and the 5% interest rate. So that discounts back those $300,000 payments. That discounts back to a total principal or lease liability amount of $272,000 with interest of about $28,000 being paid over those 3 years. So just a summary here, the lease liability is that $272,000 that we just saw. You made a $10,000 upfront payment. So that gets added to that lease liability to be recorded as part of the leased asset upfront. And then the annual depreciation or amortization expense, essentially, and it says over a systematic and rational manner in the standard, typically going to be straight line. So you would take that $282,000 divided by 3. That's where you're getting the $94,000 or the amount of the amortization expense. So just to show you some actual entries here, entity-wide or full accrual entries, the initial measurement, again, you're debiting that leased asset for the $282,000. You made an initial cash payment of $10,000, so you're crediting that, and crediting that, setting up that initial lease liability of $272,000. Then as lease payments are made, this is an example of that first $100,000 payment at the end of the year. You're reducing the lease liability by the principal portion. You're debiting amortization expense for the first year of the amortization of the lease asset. You've got interest expense, which is the amount of that payment, of course, going to interest expense. You're crediting cash for the $100,000 payment that you made. And then you're crediting accumulated amortization to offset the amortization expense. Just exactly like depreciation expense on capital assets. So I always mention the government fund entries for those of you, again, who have the GAAP basis financial statements. If you have governmental funds, you know that they have a different basis of accounting called modified accrual. even though the entries are simpler at this level of the accounting, you still have to go through the calculations. So the initial measurement or the initial transaction is you're actually recording a capital purchase or like an expense for that 282,000. Of course, you have that cash outlay of 10, and then you're recording another financing source for similar to loan proceeds or proceeds from lease for 272. So the significance there again is you at the fund level, you still have to go through the calculation of determining what the lease liability is to accurately record it at the fund level. Then as you make payments, it's all flowing through expense at the fund level, crediting cash for 100,000 and debiting lease principal expense and lease interest expense. So just a couple common questions here in terms of transition considerations to think about. Number one, does the entity need to go back to the inception of the leases? So I'm going to focus on June 30, 22. And of course, that implementation date then is July 1st, 2021. So what you have to do is you do have to take a look at that July 1st, 2021 date and look at all the potential leases that you have at that point in time. This isn't just handled for future leases. You have to look at all leases that you have at that time. So that's the starting point. And then the question is, well, do we have to go back to the beginning of time for those leases and roll the calculations forward from there? The answer to that question is no, and you're actually not even allowed to do that. You really have to look at that cutoff of July 1st, 2021, look at your leases, and look at all the future payments that you expect after that period of time, do the calculations to roll that back, and then record the offsetting lease asset that's going to offset that lease calculation. So that's something to keep in mind in terms of what transactions do you need to consider. Also, is the beginning net position, are you going to see a restatement on your financial statements? And most certainly, yes. Even if you had all capital leases before, the accounting for this is different, and the numbers might be somewhat close, but they're going to be different, and you should see and expect a restatement of your financials in all situations. So we're going to talk here for a minute about disclosures. For the disclosures, there's some nuances here with different things that are required to be disclosed with variable payments and termination penalties. Not going to talk too much in detail about that, but you do have to include a general description of your leasing arrangements. I will say, let's say you have 20 leases, I'm not anticipating this being 5 pages of footnote disclosures with every single detail about every single lease. I think it's going to be a little bit more aggregate information with some general description of what you have in terms of your leasing arrangements. The one item, though, that you will have to include for the disclosures, and basically the same thing as capital assets today. If you're familiar with your footnotes and you have capital assets, you have a table in the back of your financial statements that show beginning, additions, deletions, ending for your capital assets. You're going to have to add these right-to-use intangible assets to that table. And the leases do have to be broken out by asset category. So you'd have right-to-use intangible asset buildings, right-to-use intangible asset equipment. So that's something to keep in mind for your footnote disclosures, that you're going to include that information in the table. On the liability side, this is a long-term liability, so you're going to see that on your table in the footnotes that shows your long-term liabilities. And you're also required to show the future maturities, just like you are for debt today, where you're showing the 5 subsequent periods into the future and 5-year increments after that. So it's just something to keep in mind as you accumulate the information from the various leases that you have, what the footnote disclosures are. And as anybody who has GASB standards and helps to implement those, new GASB standards always come with some new disclosure requirements. So a few things here to think about in terms of some implementation guidance. And one of the first questions we get a lot of the times is materiality. And for those of you who are used to GASB standards, you know that there's always a caveat at the end of the standard that basically says, this needs to be applied in material situations, something to that effect. So what does that mean? Well, they don't define what that means. That lets it up to a little bit of judgment. But I will throw out that it's certainly a discussion that as you're looking at your potential contracts that you want to have with your auditors and get to some comfort level of what materiality really means. I'll use the example of a postage meter. Let's say you have a postage meter and it requires an annual payment of $500. I'll just throw out a number. Well, you know, there's a very likely circumstance that that may not be material to your overall financial statements. If it's not, you don't want to go through the effort of doing all this accounting. Obviously it's pretty complex. It's going to take some time and effort to do that. So you don't want to do that if it's not significant to your financial statements. So that's certainly a discussion that you want to have. One of the things that is laid out in the implementation guide, and I don't really have too much detail on that here in our presentation this morning, but I will mention that for various standards, GASB puts out implementation guides, and there is a very lengthy implementation guide. It's got a lot of questions and answers that are very helpful from GASB. So one of the things that they talk about in the implementation guide is a concept similar to a capitalization policy. So if you have capital assets on your financials today, almost likely you have a capitalization policy. Let's say that you only capitalize assets if the value is over $2,500. So that is something that can be applied to this right of use intangible asset as well. That's certainly something that you want to consider, updating that capitalization policy to potentially cover those right of use assets. I've also had the discussion with several clients of now's a good time to revisit what your capitalization policy is. I've had some clients where after some discussion, it's really probably lower than what it should have been. You might have an entity that has a $100 million balance sheet and their capitalization policy says $500. That's probably too low. So now's a good time to consider raising that policy if it makes sense to do that and incorporating these right of use assets. So that's a guide that you can use to help determine some of what materiality is. That capitalization policy or threshold technically doesn't apply to the liability side of things. Again, that's a discussion with your auditors to make sure that you're at a comfort level of not booking transactions. And when you look at materiality, you're not just looking at an individual annual payment. Again, you're really looking at the sum of those payments over time and getting some feel for what the total liability and asset would be. So just to kind of wrap things up here for the leases, and then I'll turn it over to Teena. Of course, the time is now. I've been given similar presentations on this for a couple years, and the message was, well, we have a little bit more time. We have a little bit more time. We don't have any more time. The time is now, of course, for our June 30 22s and for December 31st, 2022s. So ultimately, as we discussed earlier, you as the entity, you're responsible for your financial statements. You may have someone, likely your auditors, assist you with preparing the financials, but ultimately, you're responsible for the overall financial statements. So what do you need to do at an absolute minimum? And if you haven't started to do this, and this is going to apply to you, you want to start doing this right away. At a minimum, you need to accumulate the universe of the lease transactions, the contracts that you have. You want to be reviewing all of your contracts, again, whether they're titled a lease or not, next to these definitions, and understand if there are potential that you need to look at in terms of considering this accounting. Again, that may be a discussion with your auditors. Once you have the universe of leases, then you need to gather the data elements. What's those future payment streams? If there are non-lease components, they need to be broken out separately. We talked about the lease term and the discount rate. Those items will need to be determined. Once you've made those judgment calls and you have the basic data, then the next question is, how are you going to do the calculations? It can be done in Excel. There is some complexity, obviously, to these transactions for sure, but ultimately it's amortization schedules, so it can be done in Excel. Certainly, there are a lot of vendors out there who are offering different possible solutions for working with a vendor and their software to do the calculations. I will say that the vendors, what we're seeing is they typically have a per lease per year fee. It's not like a subscription where you pay a flat dollar amount. It's a per lease per year fee in most circumstances. You can also talk to your auditors. Obviously, they work and assist you with preparing the financial statements, and that's something that we are prepared to help our clients and help them with these calculations if they choose to contract with us. That's certainly a discussion with your auditors where they may be able to assist you with that as well.
All right. So what I will be going through is all the other GASBs and very quick synopsis on some of the larger ones, I have a few slides of essentially all the GASBs that have become effective within the last year, as well as up to the most recent that's been officially finalized, and then what's on the docket to come. So I'm not going to go over details of all of them and exactly what they mean and all the specifics, but I do have them included here essentially for your reference. So then you can look through, see what they are, see if you think they may apply to you. So then you can go to them and look up more information. What I will say is, as far as the GASB standards are concerned, you can obtain the standard itself and any implementation guides that may pertain to those standards. It is public information. You just go to gasb.org and all of the pronouncements are on there. You can see the full, they have full pronouncements, they have summaries, the whole gamut from the beginning of the standards when they came out. So I have it summarized here, but if you need more information, you are able to go to that website and get whatever information you need, as well as the full standard. So I have GASB 91 on here. It technically has been effective probably for all of you for at least a year, but some of you may not be done with finalizing your 2021 financials. So it could still be something that you need to deal with. But that's what I started with. Obviously, GASB 87, Craig had already spoken about. That should have been effective already, but because of GASB 95, that was delayed from an implementation standpoint. But what you have 91 for conduit debt. The omnibus standards, there are a couple of them. They come out every once in a while. They're more of random, smaller updates to existing items that they don't need their own standard, but they put a bunch of different things in almost on a yearly basis in those. So there's lots of different items in there for each of those when they're offered. GASB 93 for replacement of interbank offer rates, 94 for public-private, public-public available payment arrangements. So they're very specific things that if it relates to you, you can go and dig into deeper, but I'm not going to go into any more level here at this presentation. 95 is the standard that postponed the implementation of some existing standards that were going to be effective, like Craig said, because of COVID, essentially. 96 is what he started talking a little bit about, built a little bit into his presentation with the leases because the standards are so incredibly similar with the reporting, the requirements, the disclosures, things like that. 97 is related to component units and Section 457 plans. 98, the annual comprehensive financial report, that was strictly just a name change, essentially. It used to be called the comprehensive annual financial report, so they just changed the wording for that. That's what that standard is related to. So you just want to make sure if you file the annual comprehensive financial report that you get that change in terminology squared away. GASB 99 was another omnibus. GASB 100 is the accounting changes and error corrections. So this is an update of previous standards. This is related to any changes that you have, whether it's changes in accounting principle, accounting estimates, error corrections, if you had an error that you need to correct in your current financial statements, and any changes to or within the entity. So this could be a situation where you had a fund that was reported as major in a prior year, but it's not this year, or vice versa. It could be where you have a new or disposal of a component unit. You could have where a component unit was reported as being blended, and now it is a discrete presentation, or vice versa. So that standard will help with the reporting requirements that you need for those kind of situations. GASB 101 is for compensated absences. So again, there were standards on this already. They are updating them with this standard. So they essentially are defining a compensated absence as leave for which employees may receive one or more either cash payments for time off. So, for example, if you have vacation or sick time and you use that time during the year, payments for that, payments for unused time off. So if you leave and you get paid out any residual time off, that standard applies to how that gets recorded. And any what they consider non-cash settlements, which would be if you have, for example, time off that you're not going to get paid out directly, but it will go into a deferred compensation plan or some kind of post-employment benefit plan, then the standard will also apply to that. It does include salary-related payments, which essentially in the standard is defined as what you would know as taxes. So FICA taxes, your Social Security and Medicare, that would be included in the liability that you would be calculating. Current projects. These are what the Standards Board is working on, but are not actually at the point of being a standard yet. So they're things that they're looking into, starting to go through the process of developing the new standards that are going to relate to it, but these will be a few years out as far as finalization of the standard, and then they usually give you a little more time to ultimately implement the standard. So there's a risks and uncertainties disclosures they're looking into on what would be included in that. The conceptual framework and the financial reporting model are two pretty big ones. They're looking at them pretty much in conjunction with each other in order to finalize it, to make sure that the implementation is going to be more seamless and in line with how they want to see any changes that are coming out be reflected continuously and consistently. So for the conceptual framework, they're essentially acknowledging the fact that currently the basis of accounting or accounting concepts were not developed for the governmental environment. So they're looking at how governments work, what the best way from a framework standpoint and reporting that would work for most governments and how they actually operate, since they are unique to the for-profit or nonprofit area. The financial reporting model is basically just looking at the whole gamut of how you are reporting your activity, from the MD&A, the fund level financials, the proprietary fund financials, how you present your budgetary comparisons, all of that information. So these are expected to be pretty significant standards when they actually become finalized and need to be implemented. Revenue and expense recognition, a similar thing. If anyone is aware of the FASB standards, which are what other entities follow, what we usually see as nonprofits, from our auditing standpoint, they follow FASB. The GASB is now looking at the whole reporting model of revenue and expenses and recognition of those because of the FASB standard that recently came out. That was a significant change, and looking at applying that approach, the performance obligation approach to GASB, a GASB standard for governments. It's also looking at using the availability concept consistently across governments. Projects that have been added to the agenda, but no significant work has happened yet. The implementation guidance for 2022, that again is pretty much an annual guidance that they put out to kind of help explain existing standards, include additional Q&As based on everyone that's been implementing standards and questions they've had on that implementation. They're looking at the classification of non-financial assets and going concern uncertainties and severe financial stress. Partly this has come out with COVID, and while a lot of our governments haven't had significant impacts, there definitely has been some impact, and there's still potential for impact. So that's something that's been on everyone's mind and something that will be looked into from the GASB Standards Board as well. And then you have pre-agenda research. So this is essentially where they haven't really started anything yet, other than the fact of they put these on the docket so that they could look at existing standards to see if it would be necessary to go down the path of possible revision of those standards. Takeaways from our presentation here this morning: obviously GASB 87, it's going to affect a significant number of people. You want to make sure that you are getting ready to implement this standard, and all of the other GASB standards that potentially may impact you. I mentioned you can go to the website and get the information you need for more details on anything that may apply in any of those slides of the standards that I have that are coming down the line.